Right now, the world's most powerful financial system doesn't answer to the Federal Reserve or trade on Wall Street. An unregulated $3 trillion shadow cartel has quietly taken control of global energy grids, real estate, and artificial intelligence. No ticker symbol, no quarterly earnings call, no bank examiner walking the halls. Just a handful of private equity giants and tech companies moving trillions of dollars through contracts most people will never read. This year alone, the biggest names in tech, Alphabet, Amazon, Meta, Microsoft, are on pace to spend around $400 billion building AI infrastructure. And a huge share of that money isn't coming from banks at all. To understand how mega funds and tech giants built an off-balance sheet empire, we have to look back at a serious hidden regulatory loophole left open after the 2008 crash. After 2008, regulators did something thoughtful, reasonable on paper. They forced banks to hold far more capital against risky loans. Rules like Dodd-Frank and Basel III made traditional lending to leveraged companies expensive and slow. So banks did what any rational business does. They pulled back. In 1994, banks wrote over 70% of middle market loans. By 2020, that number had collapsed to around 10%. Into that gap stepped private credit. Investment funds, backed by pensions, insurers, and wealthy investors, started lending directly to companies. No deposit insurance, no public stress tests, no requirement to even disclose the loan publicly. What started as a niche corner of finance exploded. From roughly $500 billion a decade ago to an estimated $3 trillion by the end of 2025, according to Federal Reserve data. A parallel banking system, whisper, built almost entirely in the shadows. And now, this shadow system has found its biggest customer yet. Not struggling mid-size firms, the richest companies on Earth, racing to build AI infrastructure faster than public markets can finance it. In October 2025, Meta closed the largest private capital deal in history, $27 billion to build its Hyperion data center in rural Louisiana. The lender wasn't a bank. It was Blue Owl Capital. Here's the structure. Blue Owl managed funds own 80% of the joint venture. Meta keeps just 20%, and operational control. Morgan Stanley packaged the debt into a special purpose vehicle, anchored by PIMCO and BlackRock. Why does this matter? Because that $27 billion in debt never touches Meta's balance sheet. Meta gets a finished data center without the borrowing showing up as Meta's liability. It's expansion, quietly outsourced. Meta isn't alone. In 2024, Apollo Global Management put up $11 billion for a 49% stake in Intel's Fab 34 chip plant in Ireland, financing Intel's expansion without a traditional bank loan in sight. Then there's Blackstone. It's committed over $25 billion to build data centers and natural gas power plants across Pennsylvania alone, aiming to pull in $60 billion more in outside investment. A private firm shaping a state's entire energy future. Land parcels, power purchase agreements, grid interconnections. These used to be the domain of utilities and local government. Now they're increasingly controlled by private fund managers, whose decisions face almost no public oversight at all. So how do you make investors comfortable lending billions to build a single data center? You dress the debt up as something safe. These bonds often carry ratings as high as A+, treated almost like ultra-safe infrastructure debt. The safety rests on one assumption: that Meta,
or whoever the tenant is, keeps paying rent on a decades-long lease. Serious. Regulators at the Financial Stability Board have flagged the obvious question. What happens if AI demand doesn't hold?
Now, add another layer of risk. Payment in kind debt, or PIK. Instead of paying cash interest, a borrower can defer it, tacking the unpaid interest onto the loan's principal instead. The debt grows quietly off to the side. PIK usage is climbing fast. Some public business development companies now receive around 8% of their income this way. And Fitch Ratings found the true private credit default rate, accounting for PIK conversions, has already climbed above 5%. In May 2026, the Financial Stability Board issued a formal warning. Private credit's complexity, leverage, and hidden interconnections could amplify financial stress in a downturn. And regulators admitted they don't even have complete data on how big the exposure really is. That opacity cuts both ways. Global regulators estimate banks have somewhere between $220 billion and $500 billion of direct exposure to private credit funds. The shadow system and the traditional one are more tangled together than the name suggests. So, is this 2008 all over again? Bank executives don't think so. JP Morgan's CEO has called the private credit market still too small to threaten the system. Morgan Stanley's leadership described it as growing pains for a young asset class. But not everyone agrees. UBS has modeled a downside scenario where private credit defaults spike to somewhere between 14 and 15%, territory not seen since the 2008 financial crisis itself. There is one real structural difference. Unlike 2008, there's no vast web of mortgage-style securitization multiplying the risk. Fund leverage today sits far lower than the banks that collapsed 17 years ago. But a new kind of risk has taken its place: concentration. Trillions of dollars now rest on a single bet: that AI compute demand keeps growing, that every lease gets renewed, that every data center stays full. Picture the stress test nobody's run yet. One hyperscaler slows its AI spending. Leases don't renew. Suddenly, the safe, highly rated debt backing that data center looks a lot less safe. And it's sitting inside pension funds and insurance portfolios. This is the real story behind the AI boom. It isn't just chips and data centers. It's a trillion-dollar financial architecture built outside the rules written after the last crisis, and almost nobody watching it happen in real time. The question isn't whether AI infrastructure gets built. It's who actually owns the debt behind it, and whether the rest of us find out before or after something breaks. That was it for today's video. I hope that you not only enjoyed it, but learned a thing or two as well. Subscribe to the channel so you always know what's changing and what actually happens behind the curtains. Take care, and I'll see you next time.